Hey there, and welcome to this explainer. If you're someone who loves cutting right to the chase and learning efficiently, well, you are in the exact right place today. We're going to dive into a topic that honestly affects almost every single one of us, yet it is just so wildly misunderstood. We're talking about how to legally reduce your tax liability. Basically, how to shift from being a passive tax filer to a proactive, year-round tax planner. We've pulled together some fantastic insights from recent financial guides, and my goal today is to make these complex tax mechanics incredibly easy to digest. So let me ask you a serious question right out of the gate. Are you tipping the government? I know, it sounds like a joke, right? But the truth is, every single year, millions of taxpayers passively overpay their taxes simply by missing out on entirely legal opportunities. You're essentially leaving a tip on a bill that you did not have to pay in full. A larger tax bill or a smaller refund isn't always because of high tax rates. Actually, more often than not, it's the direct result of leaving money on the table that absolutely should have stayed in your own pocket.
All right, here is our game plan for today. We'll start with number 1, the passive filing problem. 2, deductions, exemptions, and credits. 3, commonly missed deductions. 4, smart strategies. 5, the calculator advantage. And finally, number 6, avoid costly mistakes. Let's jump right in. Section 1, the passive filing problem.
You know, most people only really think about taxes in March or April when the filing deadline is just looming over them. But here's the secret. The folks who consistently pay less tax, they're thinking about it all year long. When you just file passively, meaning you take whatever your employer's automatic calculations say, cross your fingers and hit submit, you're almost guaranteed to overpay. Reducing your tax liability isn't about finding shady loopholes or cooking up complicated schemes, not at all. It's strictly about understanding what the law already allows and making deliberate, smart decisions about your money throughout the year.
Section 2, deductions, exemptions, and credits.
Okay, so a crucial first step is understanding the tools in your toolkit because there is massive confusion between these terms. Let's look at deductions first. A deduction simply reduces your taxable income. So let's say your gross income is $120,000 and you claim $15,000 in deductions. Well, your taxable income drops to $105,000. You literally aren't taxed on that $15,000 at all. On the flip side, tax credits are kind of the holy grail. They don't just shrink your income pool, they offer a dollar-for-dollar reduction of your actual final tax bill. If your final calculated tax debt is, say, $4,000 and you have a $500 tax credit, boom, your bill instantly drops to $3,500. And then we have tax exemptions. Exemptions mean that specific types of income simply aren't counted as taxable before any of the math even starts. Really common examples of this are the house rent allowance, or HRA, and leave travel allowance, LTA. The money still exists in your bank account, sure, but it gets completely excluded from the taxman's view. Understanding which bucket your benefit falls into, make sure you don't confuse a partial benefit, like a deduction, with a massive full benefit, like a credit.
Section 3, most commonly missed deductions. The absolute most expensive tax mistake isn't a math error. It's simply not claiming what you are already entitled to. So here's a rapid-fire look at what people constantly leave behind. Under Section 80C, so many people just contribute the bare minimum their employer asks for retirement, completely missing out on maximizing that deduction. Then we have Section 80D for health insurance premiums. This one is heavily ignored by younger folks who think, hey, I'm healthy, why bother? Which completely misses the tax benefit for covering themselves or their parents. Also, don't forget Section 80G for charitable donations to approved institutions. Oh, and for the freelancers or self-employed out there, directly related business expenses like your internet, equipment, or home office utilities are incredibly undercounted, usually just because of bad record keeping. Now, here is a fact that genuinely shocks people. Under Section 80E, the interest you pay on loans taken for higher education, whether that's for yourself, your spouse, or your kids, is fully deductible with absolutely no upper cap, literally, no limit. This is such an incredibly powerful tool for anyone dealing with student debt, and yet so many people fail to report it simply because they have no idea that the cap doesn't exist. And if you're a homeowner, this next number is just as vital for you, $200,000. Under Section 24, if you have a home loan on a self-occupied property, the interest portion of your EMIs, your equated monthly installments, is deductible up to $200,000 per year. When you stack this with a principal repayment deduction under Section 80C, buying a home suddenly becomes one of the most tax-efficient financial moves you can possibly make.
Section 4, smart tax savings strategies.
Okay, so finding these deductions is great, but just knowing they exist isn't enough. You have to use them strategically to build your wealth. The single biggest habit change you can make here? It's all about timing. If you make your tax-saving investments at the very start of the financial year in April, rather than dragging your feet until February, that money actually works for you all year long. Waiting until February just leads to deadline panic, where you end up locking yourself into some suboptimal investment just because the clock is ticking. So plan early, review your position quarterly, and invest deliberately. And as we dive into these more advanced tactics, remember, always invest with a real purpose, not just to dodge taxes. Your financial instruments need to match your actual life goals. We also see some brilliant strategies like income splitting. For instance, if a family member is in a lower tax bracket, structuring some investments in their name can legally drop the overall family tax burden. Another amazing tactic is tax loss harvesting. That's strategically selling your underperforming investments before the year ends to offset your capital gains. And for eligible families in certain regions, setting up a Hindu undivided family, or HUF structure, is a fantastic move because it creates a separate legal entity with its own brand new set of exemption limits. Section 5, the tax calculator advantage. Now, you might think of a tax calculator as just a boring math tool, but in modern financial planning, it is a total game changer. Let me give you a super simple 5-step checklist for using one. First, enter your gross income. Second, add in your exact deductions, using real statements, not just guessing. Third, compare the regimes. A solid calculator will instantly run the old versus the new tax regimes side by side to tell you what's actually better for you. Fourth, play around with what-if scenarios, like, what if I boost my health insurance? What if I prepay some of my mortgage? And finally, step 5, use all that data to align your actual investments before the financial year closes out. I absolutely love this quote from our source material today. Seeing the exact rupee impact of each deduction turns abstract planning into concrete motivation. Think about it. When a tax calculator shows you that making one extra contribution will drop your actual tax bill by a very specific, tangible amount, the decision becomes a total no-brainer. It takes all the guesswork out and makes those benefits feel real before you've even committed a single cent. Section 6. Avoid these costly mistakes. Now, even with all the right tools, you can still trip up. These are the classic, unforced errors that silently drain wealth from passive taxpayers year after year. Like ignoring your non-ADC deductions just because you're only doing what your employer asked, or failing to keep your receipts. Look, if you don't have the proof, a deduction can easily be thrown out during an audit. And filing passively based only on your Form 16 or employer's default TDS, that means you are completely ignoring your outside investments or side income. And of course, the big one, choosing the wrong tax regime because you just assumed the new one was simpler without actually running the numbers. So let's bring this whole thing together. Deductions? They're the what of tax saving. The tax calculator is the how much. Knowing a deduction exists is a great start, but quantifying exactly how a mix of health, housing, and retirement deductions impacts your unique life, that is actionable intelligence. When you combine smart knowledge of deductions with real-time tax math, you create this incredibly powerful feedback loop for your financial health. It basically means you get to walk into tax season with absolute confidence. Which leaves us with one final and honestly the best question. What will you do with your tax savings this year? Seriously, remember that every single legal deduction exists because lawmakers specifically wanted to encourage things like saving for retirement and buying homes. The system is working exactly as it's meant to when you claim them. So let's stop overpaying. Use the frameworks we talked about today, crunch your numbers early, and take real control of your financial future. Thank you so much for hanging out with me for this explainer, and I absolutely cannot wait to see you for our next topic.